Good morning, I'm Gary DeWaal, and this is Bridging the Week for July 1st through 5th, and today is July 8th, 2019. The United Kingdom's Financial Conduct Authority proposed to bar the marketing and sale to retail persons of derivatives and exchange-traded notes based on cryptocurrencies and utility digital tokens. Separately, the CFTC and the Chicago Board of Trade sanctioned a Hong Kong-based hedge fund for a one-day position limits violation. Among its penalties, the fund agreed to pay back money it saved by liquidating its positions in excess of federal limits. If Memorial Day marks the unofficial beginning of summer in the United States, July 4th, which just passed, tells you that summer is now in full swing. So I can get out and enjoy the hot, sticky, and painful days of very hot and humid weather. Let's get started. The UK's Financial Conduct Authority proposed to ban the sale, marketing, and distribution of all derivatives and exchange-traded notes referencing unregulated crypto assets that can widely be exchanged on crypto asset platforms or other forum to UK-based retail persons. Generally, the proposed ban would include derivatives and ETNs based on cryptocurrencies and so-called utility tokens to the extent they are created on public blockchains and are readily transferable. The ban would not include derivatives or ETNs referencing security tokens, digital tokens that are unregulated but not widely transferable, or tokens that constitute e-money and subject to the FCA's electronic money regulations. Futures, options, and contracts for differences are types of derivatives that would be included in the proposed ban. FCA's prohibition would apply to affected products sold, distributed, or marketed from the UK to retail clients, including sales to UK clients from the European Economic Area, even where the clients seek such products proactively and are not solicited. FCA claimed that it was proposing its ban because of the complexity of the affected crypto assets and the lack of transparency around their valuation, the prevalence of market abuse and financial crime in the secondary market for crypto assets, retail customers' apparent lack of knowledge and understanding regarding affected crypto assets, and particular characteristics of the relevant derivatives and ETNs, including leverage and volatility of the underlying assets. Unrelatedly, in the United States, Congresswoman Maxine Waters, chairwoman of the House of Representatives Committee on Financial Services, and various subcommittee chairpersons requested that Facebook and its partners, quote-unquote, immediately consent to a moratorium on the development and introduction of Libra, its proposed cryptocurrency, and associated initiatives. To me, FCA's proposed retail ban sounds very much like Massachusetts' 1980 ban of its citizens from participating in initial public offering of a then small startup company named Apple Computer Inc. This ban seemed wrong at the time and certainly seems wrong now. Governments are rarely better than individual investors, including retail persons, in determining what might be good investment opportunities. The government is better off at defining disclosures and perhaps suitability rules, not in banning products. For my detailed analysis of FCA's proposed retail cryptocurrencies derivatives ban, check out the article version of Bridging the Week at www.bridgingtheweek.com. The Commodity Futures Trading Commission and the Chicago Board of Trade brought and settled enforcement actions against IFUS Investment Management Limited, a Hong Kong-based hedge fund, for violating the spot month speculative federal positions limit for wheat futures on one day in 2017. To settle this matter, IFUS agreed to pay a fine of $160,000 to the CFTC and $50,000 to the CBOT. IFUS also agreed to pay the CBOT $166,590, an amount CBOT claimed the firm saved in reduced losses through its through its liquidation of the amount of position limits violation. According to the CBOT, on November 29, 2017, IFUS held a futures equivalent net long position of 1,680 December soft red wheat futures contracts in excess of 1,080 contracts over the spot month position limit of 600 contracts. After IFUS was required to take delivery of a very large portion of its December long position and was assigned 1,185 wheat certificates, the firm rolled its remaining spot month futures contracts and entered into short positions to retender its certificates, effectively liquidating all its spot positions, including its violative positions. It did this by selling 1,680 lots of a December 2017, March 2018 wheat futures spread. The CBOT and CFTC claimed these transactions contributed to a reduction of loss the company otherwise would have incurred as a result of violating position limits by $168,590 US. Wow! Who would have thought that a smaller loss achieved by liquidating positions acquired in excess of position limits would also have to be repaid, not just profits made? Well, that's it for this week's edition of Bridging the Week. As always, there's more information in each article and more articles in the article version of Bridging the Week on the website. Check it out. I'm Gary DeWaal. Have a very nice week, and until the next edition of Bridging the Week, ciao.